Welcome to the Stock Market Palantir. Today we are going to talk about BB, BlackBerry Limited. Right now it's trading around $4.02, and it really represents this paradox in the modern market. We're looking at a company that, by all accounts, successfully pivoted from legacy hardware into a high-security software powerhouse, and yet the share price is just stubbornly stuck. It feels completely detached from the value that's, embedded deep within its tech.
It is a fascinating story. I mean, you're absolutely right. We're seeing this clear divergence between the technical progress, which is undeniable, especially in automotive, and then the brutal reality of how the market is valuing it.
Exactly. And that's the core question here, isn't it? Is BB this asymmetric, deep value opportunity that's built on a unique operational moat, or is the stock price actually right? Is it just accurately reflecting these complex market mechanics and the psychological burden of delayed revenue?
Right. It's the tension between a future, maybe near certain cash flow, and the overwhelming structural forces of right now. And I'll be arguing that those forces, the market mechanics, the overhead supply, investor exhaustion, they're what's really dictating the price.
And I'll be arguing the opposite, that the fundamental embedded value of BlackBerry software, driven by its specialized, non-negotiable moat, it just far outweighs the short-term market noise, and that positions the stock for a significant re-rating once those revenues finally hit the books.
Okay, well, I come at it from a different way. Before we dive into the nitty-gritty, we have to acknowledge the first thing a traditional investor sees, the PE ratio. It's sitting around, 120? That triple-digit multiple is screaming that investors are paying for future earnings, QNX and IV specifically, but it also signals that the market is pricing in near-perfect execution, which is a huge ask.
I see why you'd focus on that PE, I do. But let me offer a different perspective. That multiple, it isn't really a valuation of today's earnings. I think it's more of a placeholder for the sheer certainty of the royalty streams coming in 2027, 2028. The tech transformation is done, it's complete. So the current price is, in my view, a profound mispricing of that embedded, almost guaranteed value.
Guaranteed is a very strong word, given the timeline, but I'll concede the underlying technology is robust.
ISO 2626 ASIL-D safety layer. And for anyone listening who isn't familiar, ASIL-D is the highest level of functional safety. It's for systems where failure could cause, serious injury or death. This isn't optional software.
And we saw the proof of that with the NVIDIA Drive Thor platform integration. 2,000 teraflops of AI compute, and QNX is the foundation. That's key.
Exactly. It makes BlackBerry the essential safety gatekeeper for all the next-gen software-defined vehicles that are moving into mass production in 2026, 2027. This is long-term, high-margin royalty revenue that's already locked in. And just as critically, they've specialized. They wisely abandoned trying to compete on volume with, say, CrowdStrike to focus on these high-security endpoints, like securing 17 of the G20 governments. That gives them stability.
And while that technology story is genuinely compelling, the stock price reflects market mechanics that, right now, just overwhelm it. The price is trapped in this tight consolidation range, about 35% below its 52-week high. To me, that just screams execution risk and deep, deep investor exhaustion.
The price ceiling is frustrating, I'll give you that. And that November sell-off after the NVIDIA news, it felt completely irrational.
Oh, I wouldn't say irrational. It was a textbook sell the news event. That announcement was already priced in. So when it didn't cause an immediate, explosion in the stock price, the money just rotated out. And that was made worse by macro pressure on all these high multiple growth names. Plus, you have this psychological ceiling around $5, constantly reinforced by analysts who just put out a hold rating. The market is waiting for the financial story to catch up to the technological one. And the wait is it's taxing.
Okay, so let's talk about that. Let's talk about liquidity and who is really setting that price. We have to look at the institutional activity. Let's dive into the dark pools and the off-exchange volume, which you're pointing to as a major drag.
Well, the data is highly suggestive of institutional price suppression. I mean, we frequently see over 35% of BB's trading volume happening off-exchange. And more worryingly, the off-exchange short volume ratio, it stays persistently high, 36 to 38%. You combine that with massive spikes in failure to deliver, and analysts start to interpret that as FTD resetting.
Hang on, can you just unpack that for the listeners? What does FTD resetting actually mean in this context?
Sure. It's essentially a mechanism where large institutions can, manipulate the timing of their short covering. By strategically failing to deliver shares they sold, they can sometimes cover those obligations later, cheaply, off exchange. It lets them maintain downward pressure without having to buy on the lit market, which would, cause the price to spike. That level of opacity, it just crushes retail confidence.
I appreciate the explanation of the mechanism. However, I'm just not convinced the motive is purely malicious price suppression. I'd offer a different perspective. A lot of this heavy volume is simply market maker hedging against retail option flow, a process they call short gamma.
And what does short gamma hedging mean for the price?
Well, when retail buys a ton of calls or puts, the market makers who sell them have to hedge their own risk. So if the stock moves aggressively, they are forced to buy or sell the underlying stock to stay neutral. They often do this in dark pools to avoid causing huge volatility on the main exchange. So here's the key takeaway for me. The fact that this high volume is happening off exchange while the price consolidates, instead of crashing, that suggests stabilization, maybe even accumulation, not an aggressive short attack trying to collapse the stock.
Stabilization, maybe, but that doesn't change the fact that the opacity prevents clear price discovery for everyone else, which hurts confidence and limits the upward momentum you need for a real breakout.
And just to quickly address that persistent market rumor, I'm not even sure why we'd have to talk about a reverse split. It's completely baseless. The company is NYSE compliant, it's trading way above the minimum, its history is forward splits, it's a distraction.
Fair enough. Let's pivot to the second point then. The structural psychological ceiling. We've talked about the analysts, but the internal dynamics of the shareholder base itself are, they're crippling. The stock faces this acute technical rejection at the $4.50 to $5 block, and it's because of what people call the bag holder's dilemma.
So you're talking about the overhead supply from, the 2021 squeeze?
Exactly. You have this huge mass of long-term retail holders who bought in at $10, $15, even $20. When the stock rallies toward $5 or $6, they don't see the start of a new uptrend. They see a one-time chance to get out at a more manageable loss. So this continuous stream of sellers just hits the market every single time the price tries to break out, creating this powerful ceiling.
I acknowledge that overhead supply is real, I do, but I believe the underlying conviction of the new money coming in has fundamentally shifted. I'd frame it differently. The thesis has matured. It's moved past this short squeeze play into a sophisticated, deep value thesis, the NVIDIA proxy. The sentiment now is more like high conviction, low patience. The problem isn't a flaw in the thesis, it's temporary exhaustion. New money coming in at $4 sees those $5 sellers as a temporary hurdle, not a permanent wall.
But that high conviction leads to unrealistic expectations. We saw it before earnings. Retail sentiment was sky high, and when the results, which were solid, failed to double the stock overnight, the sell-off was deep. That volatility just pumps up the stock's high beta, 1.51, which means it punishes shareholders disproportionately during any macro rotation. It makes it really unattractive to risk-averse funds that need stability.
Which brings us to the revenue lag and execution risk. The growth is secured, it's lagging. The Ivy platform has major design wins, like with the Foxconn MIH consortium and Mitsubishi Electric.
Those are strong partnerships, no one's denying that.
But the key is understanding the lag. A design win today, in 2025, generates almost no revenue now. That revenue only starts to flow when the cars are mass-produced and sold, which everyone projects for 2026 and 2027. This lag is a known variable, but the market discounts those future cash flows so heavily. And that heavy discounting is the single biggest reason the valuation is so low.
That's a compelling point about the timeline, but you can't just ignore the execution risk. That risk is amplified by their history. I mean, we both remember the BB10 phone OS. That was promising technology that completely failed commercially because of poor execution and bad market timing.
That is the classic bear case, and it's an important historical point. But I would argue the risk profile is fundamentally different now. With BB10, they were competing against tech giants for fickle consumer adoption. Now they are providing mission-critical, regulated infrastructure to car manufacturers. Their success is tied to regulatory necessity, not trends.
The moat could still erode, though. While QNX hypervises platforms like Android Automotive OS now, competitors are always pushing into the safety layers. If Linux or another platform achieves ASL-D certification, and there are major efforts underway, that monopoly position could be seriously challenged by 2028 or 2029.
ASL-D certification is an extremely high barrier. It takes years of validation in an environment where mistakes are literally fatal. It is a massive economic barrier to entry that QNX built decades ago. It's a risk, sure, but it's not an immediate threat.
Regardless, the immediate structural problem is still there. The reliance on other people's sales volume. The revenue is a royalty. It's based entirely on OEM production schedules. So BlackBerry has very little control over its own revenue acceleration. It's totally dependent on the success of the global automakers, which introduces a whole layer of external risk.
I think we've thoroughly explored this duality, the deep intrinsic tech value on one side and the structural market pressures on the other.
Indeed, the core conflict is very clear.
So my position remains this. The whole narrative is an asymmetric bet on the digitization of the automobile. The pivot was successful, the code is in the cars, the partnerships are sticky. A valuation of around $1.93 billion could look extraordinarily cheap if that 2026-2027 adoption curve materializes. For investors focused on fundamentals, patience measured in years is the key.
And my summary is this. The company is sound, it's solvent, but the financial transformation is lagging far behind the technical progress. The price is correctly reflecting the drag from market mechanics, overhead supply, institutional dominance in dark pools, and the very real risk of execution failure and revenue delay. We both agree the value relies on future adoption, but the market structure just makes any sustained price appreciation incredibly difficult in the short term. It's a story of two timelines, one tech and one financial, and they are not in sync.
We've really explored the forces pulling on this stock, the deep value of that QNX monopoly, pitted against the relentless pressure of market structure and psychology.
And there is clearly more to explore in the material, especially around the pace of IV platform monetization and how those external risks might play out.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.